everybody. Thank you. Welcome, and thank you for attending our webinar. I would like to open up by saying NAFA is proud this year to celebrate 50 years of supporting aircraft finance and everything that goes into that. It is our 50-year anniversary, and 50 years is a big accomplishment by most standards. We're proud of our association and grateful to all of our wonderful members who have made this possible. So thank you, everybody. Today's webinar, our topic is going to be looking back at 2020 and doing a recap, and then looking forward, what can we expect from this year? As we all know, last year was a truly unique year for everyone involved, but as I think we're beginning to see, it has had a positive impact on the aviation industry. Today's panelists will be talking about what happened in 2020, where we are today, and what we can expect going forward in 2021. Our wonderful moderator is Nell Stubbs, with Vice President of Conklin and Decker, which is a JSSI company, and I will turn it over to her to introduce the panelists and take it from here.
Thank you, Tracy. Good morning, everyone. Looking forward to this. This ought to be interesting. I know I learn something new every single time I go to a webinar. Our panelists, I'm going to start off with, I'm just going to introduce them all at one time. Roland Vincent, known as Rolly, President of Roland Vincent Associates LLC and JetNet IQ Creator and Director. He does have the longest title of all of us, so he wins. He has 35 years in the aviation industry, and he has served as a trusted independent consultant in various roles in strategy, marketing, business development, aviation economics, and statistics. He is a resource that I know that several of us, or most, or all of us, should be using. Our another panelist is Tony Koussis, President and CEO of Asset Insight LLC. He's been in the aviation business for a long time. I know I've known him for a long time as well. He's a published author, an active industry association member. He's been serving on the board of NAFA for as long as I can remember. He's also past chairman of the International Aircraft Dealers Association and a member of the TRB Business Aviation Subcommittee. Our third panelist is Don Spieth, Vice President of Sales and Analytics at General Aviation. He was at General Electric for 10 years and held senior leadership positions in energy services, power generation, and corporate communications. But he attributes data analysis and the use of analytics to his success in commercial roles over his 25-year career. And last but not least, Andrew Young, General Manager at Amstat. He joined Amstat in 1994. Can't believe I've known you that long. And since 2013, he has served as the General Manager for Amstat Market Research Business. He is an active member of the business aviation community, having served on various boards, NAFA, NARA and IATA, and the HAI Finance and Leasing Committee, and now recently is the IADA Products and Services Member Advisory Council member. Those are our four excellent panelists. I look forward to hearing from them. I will pass on to, and I don't remember, who is the first speaker?
Well, I believe that's me.
Thank you, Andrew. Andrew, take it away.
Right, thanks, Nell, and hi, everybody. It's nice to talk to you, albeit remotely. I've been tasked today with providing the 2020 recap part of the webinar. So we're going to look at 2020 in review and also look at the first couple of months of this year, looking at the business aircraft fixed wing resale market, specifically looking at inventories, transactions, and aircraft values. So without further ado, let's jump right in. This first slide shows you the number of aircraft for sale since the beginning of 2019, and this is pre-owned business jets and turboprops globally. The black line at the top of the chart shows you the number of units for sale, and then the dotted orange line shows you the number of new listings for sale that Amstat reported on a monthly basis. The key takeaway here is the significant drop in availability in the last 8 months. So about a 23% contraction in the number of business jets and turboprops available since the middle of 2020. Now that peak is interesting. The The number of aircraft for sale was actually increasing. It's a trend that had been increasing since about 2018, an upward trend, and peaked there at 3,500 units at the middle of 2020. It did accelerate a little bit when COVID first became an issue. But that peak of 3,500 should be looked at in some context. It's not as high as the number of units we saw for sale back in 2016, as recently as 2016, for example, when there were about 3,800 units for sale. And it's nowhere near what we saw back in the Great Recession in 2009, when there were about 4,800 units for sale. So a peak, certainly, but not a significant one. But really the key takeaway from this slide is that significant contraction in inventory. There are simply fewer aircraft, fewer business jets and turboprops available for sale today than there were 8 months ago. Next slide, please. Okay, so in this slide, we're looking at transaction activity. On the left-hand side, we're looking at the global business jet and turboprop retail transactions. So these are pre-owned aircraft sold to owners and operators. And then on the right-hand side, I've also included, for comparison purposes, the same data, but for new deliveries. These charts look at the data comparing 2020 in orange to 2019 and look at it on a quarterly basis. So if you just draw your attention, first of all, and we're going to focus most of our time on the retail transaction chart on the left, because other speakers are going to talk more to the new deliveries. But if you look at that chart on the left, you can see that actually in quarter one, in 2020, we pipped 2019 by 1%. So things were looking okay. But then quarter two hit, and as we all know, things kind of went south at that point. And as you can see, that is reflected in the transaction activity with that 26% reduction quarter two 2020 versus quarter two of 2019. Then things started to claw back. And as you can see there in quarter three, activity was actually 20% higher than quarter three of 2019. And then quarter four was just a blockbuster, a 49% increase in quarter four 2020 versus 2019 in the number of retail transactions. Simply amazing. And the net result of all of that is that year over year, there were 15% more pre-owned business jets and turboprops sold in 2020 than there were in 2019, which is quite remarkable considering how far behind we were at the end of quarter two. I'm going to just let other speakers talk to the new deliveries, but obviously on the right-hand side there, you can see a slightly different story with new deliveries. Although in quarter four, they too saw a significant uptick, albeit slightly less than quarter four of 2019. So now we've looked at supply, we've looked at demand. Let's jump in and look at the impact of those factors on aircraft value. So if we could just jump to the next slide. Now these slides, these next 5 slides represent the short-term medium values of the 5 major fixed-wing business aircraft pre-owned segments. So heavy jets, super mid, medium jets, light jets, and turboprops. And in each one of these slides, what we've done is we've got a value chart at the top of the page. We calculate this short-term medium value every 2 weeks. And the chart at the top shows you the ups and downs. Obviously, the green are upticks, the red are downticks. And then for comparison, we've also included the retail transaction activity by month along the bottom of the page. I'll point out, by the way, that the January and February numbers are not quite complete. A quick point of clarification on the value charts. It's our intent to show trends in these charts for the short-term medium values, and we've aggregated the data here for the purposes of brevity. It's important to note that for individual makes and models, and indeed for individual serial numbers for that matter, the individual trends may vary to a greater or lesser degree than this overall aggregated trend. And it's one of the reasons why we created our valuation tool in the first place. So the bottom line is that individual experience may vary. Yeah.
Andrew, we have a question that I think is an appropriate time to ask questions.
Yeah, fire away.
Yes. How do you see new deliveries trending in 2021 versus the 2020 exit rate of down only 8% in fourth quarter 20? How does that vary by cabin size or manufacturer? So it's basically 2 questions. How do you see the deliveries trending in 2021 versus 2020 exit rate of down only 8% in fourth quarter 20? And how does that vary by cabin size and manufacturer?
That's a great question. So I would imagine, and for those of you that know me, you know I like to look at the data before I answer any question. But I would imagine that given that the inventory levels have contracted so much in the used market, that the manufacturers are going to have less competition in 2021. So presumably that would have a positive impact on new deliveries. If we look at the breakdown of activity, if we follow that idea through and we look at the breakdown in activity and where were the transactions, where were the transactions most significantly increased year over year, 2020 versus 2019, you start seeing that in a way you saw that most significantly was in the middle part of the market. So the light jets and the medium jets. So presumably, given that those markets are going to be tighter going forward on the pre-owned market relative to the other markets, which are all going to be tighter bottom line anyway, presumably the new delivery or the manufacturers that focus in those particular markets are going to see the greatest benefit of a tighter pre-owned market.
Thank you. Thank you, Andrew.
Okay, so if we could jump on then to the super mid. Oh, I'm sorry, just go back to it. I didn't finish on the heavy jet there. Let me just go back there if you could. Super. So looking at the value chart there, the overall takeaway is that you see that significant drop in median values for heavy jets in the first 6 months of last year. And that drop was about 16% in between Q1 and Q2. The good news is that since the end of Q4 of 2020, we have actually seen some of that value being recovered, and values have actually gone up about 10% in the last 2 or 3 months in the heavy jet segment. And this has been driven by the significant uptick in transaction activity. If we look at just the heavy jets, the second half of last year, transaction activity was actually up 41% compared to 2019. And at the same time, the inventory levels were down 23% over the last 6 months. And so that reduction in supply and that increase in demand has had has created some upward momentum on values. All right, so if we could now jump to the super mid. So looking at the super mid market, and again, those two charts there, the key takeaway here from the value chart is that the reduction in the median values for super mids was a little bit more protracted. Really, whereas the heavy jet was sort of very much took place in Q1 and Q2, you can see here in the super mids, there was a little bit more protracted. It kind of went from Q1 into Q3. And that overall reduction was about 17%. That's a net of 17%. If you actually look at the slight uptick, that number would have been bigger if you take into account the uptick of about 5% at the very beginning of the year. That's actually true of the heavy jets as well on the previous chart. The good news here is, again, that we do see a recovery of some of that value loss of about 10% since the beginning of December last year. And again, that's been heavily driven by the significant uptick in transaction activity, up 55% in the super mid market year over year for the second half of last year versus 2019. And also the significant contraction of about 21% in the availability of super mid jet units as well. All right, let's go on to the medium jet. So looking at the medium jet market, this trend here on the value chart very much follows the heavy jets in that the contraction, the reduction in median value really occurred in the first 6 months of 2020. That reduction was about 22%. Again, we are seeing, as we saw in the other markets that we've looked at so far, a slight recovery in values in sort of the beginning of December through to the present day. It's a little shallower, the recovery only about 6% for the medium jets compared to 10% for the super mids and the heavy, but it is a recovery. And again, or has been recovering. And again, that's been heavily driven by the significant increase in transaction activity on the medium jets and also the contraction in inventory over the same sort of 6-month period. Moving on to the light jets. So the story here is a little different than the other jet markets that we looked at. What you see here is a reduction in median values for light jets that took place pretty much throughout the entire, or at least the first, or the 11 months of 2020 from January through to November. That reduction represents about a 28% decrease. So the most significant decrease in median values of all the markets that we're going to look at today. There is, again, that recovery that sort of starts mid-December, and this market has recovered about 10% of that value from the middle of December through to the present day. And again, heavily driven by the increase in transaction activity at the end of last year, actually up 43% for light jets for the second half of 2020 versus 2019. And that contraction in inventory that we saw in the other markets, in the case of light jets, it was down about 28%. So significant contraction in availability in this market as well. If you'd like to just go on to turboprops, this is the final slide. And the chart here a little different, a little shallower, if you will. The turboprops saw a contraction or reduction in the median value pretty much throughout 2020. Although, again, you tend to see more of the activity, more of the reduction happening in the first half of the year. Was less than in the jet markets. The median values only came down about 11%. I say only, but they came down 11%. And we see that recovery in more recent months, although it looks like in the turboprops, it happened a little earlier. The jets started to see values head back up again a little bit more in the sort of mid-December time frame, whereas the turboprops, we started to see that in the data mid-November. And so whereas the turboprops came down about 11% in value through 2020, they've since recovered about 4% of that value. And again, that upward trend driven by a significant increase in demand and a contraction in the supply of used turboprops available for sale. And with that, Nell, I'll pass back to you.
Thank you. Thank you so much, Andrew. I have one more question for you. How has the contraction in pre-owned inventories changed the market dynamics?
Yeah, that's a great question. So holistically, as we saw on the charts earlier, the inventory levels overall have contracted 23%, and to greater or lesser degrees, depending on what part of the market you're looking at. I did actually look at the data because, you know, aircraft come off the market either because they've sold or because the seller decides to withdraw them. There was no significant change in the number of withdrawals last year. And so this reduction in inventory is heavily driven by the increase in transaction activity. And what the data suggests is that that increase in transaction counts, a lot of those transactions favored younger and lower time aircraft. They were kind of picked off or cherry picked, if you will, from the market. And that's kind of reflected when we look at the inventory levels, right? The contraction, if we look at inventory based on age, we see a greater contraction in the inventory of younger and newer aircraft versus the less than equal to 10-year-olds serial numbers versus still a contraction, but a less of a contraction in the older part of the market, the sort of 20 years and older. And equally, when we look at the market, we see, particularly over the second half of last year, we see average total time for each market going up, days on the market going up, the average age going up in each market. Again, kind of supporting that idea that the younger aircraft were cherry-picked from the listings for sale. And as you know, the transaction side as well, as I think about it, we also saw a greater increase year over year. There was an increase year over year in all transaction activity, pretty much in all segments, but it was particularly noticeable in the newer part of the market, with about 40% year over year growth in those transaction activity in the second half of last year versus maybe sort of 20 or 30% for the older part of the market. So the bottom line is that, you know, this was a tide, this increase in transaction activity was a tide that lifted all boats, but for sure favored the younger, the lower time aircraft. And so the end result is that buyers today have less choices, less of those younger and those lower time aircraft to pick from.
So Andrew, to one more question before we get on to our next speaker. As we have seen values across all market segments in the first 6 months drop, and as we close 2020, values rebounded. What about asking prices? Do you see those values fluctuating similarly?
I did briefly look at the asking price data, and throughout 2020, those largely contracted. The average asking price in each market came down throughout the entire year. One would presumably, and again, I haven't specifically looked at the asking price data of late, but presumably, as the good news comes out about what happened, right? There's often a delay, that the expectations for sellers kind of reactive to what's going on in the market. And as they hear this good news about how transactions were picked up in the second half of the year and the positive impact that had on values, that's going to have some folks looking to start increasing their asking prices when they start to list their aircraft. But overall, last year asking prices came down.
Yes, thank you, Andrew. I'd like to now introduce Don Spieth, and Don, take it away.
Thanks, Nell. On my first slide, you'll see the new deliveries. Now, before I get started, let me say thanks to the NAFA team and Tracy Cheek and Jim Blessing. A lot of these things take a lot of calories that we don't see, so I want to thank them. Also, Amstat, Andrew, you and your team, Greg Duxon from General Aviation Services, and then the Van Buren Advisors and Bloomberg Intelligence team. I'm going to show you a perspective of some of the things that Andrew has spoken about and some of the things that you'll probably hear from Tony and Raleigh as we progress. But I'm going to show you the historical perspective and how 2020 compares all the way past the last 10 years and back through the Great Recession. So the chart that I have up now is showing a stacked perspective, a stacked area chart. And what that means is all of these start at that left-hand number of aircraft, and the area represents that growth across turboprop, light jet, medium jet, super mid, and heavy jet. So really the noticeable thing that I see here is that after the Great Recession, you see that the manufacturers had delivered about 70% over an overcapacity from 2007 to 2009 from what you saw the next 10 years on new deliveries. And that really was quite a shock to see. We've shown this chart before for some of our clients, but really the tell that I see here and the difference from, say, the 2020 and the Great Recession is that the manufacturers were very disciplined, a lot more communication. So even the orders that they pushed to the right, including into 2021, were all orchestrated with their clients. And what you saw there was that some of these new deliveries that were pushed to the right helped those flight departments that weren't flying as much. And it also didn't cause a supply disruption by introducing an aircraft to the market, because as you know, most aircraft manufacturers, most of the corporate world, when they take on a new aircraft in their fleet, they dispose of the aircraft, their existing aircraft. So again, I think the most telling thing here is for 10 years, the manufacturers delivered around 1,000 aircraft a year up until last year. And quite honestly, it didn't fall off too much from the year before. If we can move to the next slide. This shows the historic retail sale by group. And when you look here, you see that dip in 2009. The 2009 aircraft were actually around 2265. So that represents a pretty big fall compared to the year before. So that chart actually, I think, shows 2008 when it's 2009. And one of the things to notice is, if you look to the right, that the aircraft, again, a stacked chart of turboprop, light jet, medium jet, super mid, and heavies going across, and the average 10-year was at about 31, 32. And then looking at what happened in 2020, you see that the retail did reach the highest number at 3548, which just topped 2018, which was probably one of the better years in recent history. So we're just about 13% off of that if you look at the 10-year average, and about 15% off of year over year. And one thing to note is that Andrew's numbers and my numbers may vary just slightly in that I've excluded some of the business liners in piston on the turboprop side. If we move to the next slide. What I wanted to try to do here is give you an idea historically of really what happened compared to the Great Recession. So with COVID, what we saw as opposed to, the Great Recession was more of a financial meltdown and an oversupply situation, obviously, where what we saw in 2020 with the quarterly perspective is the demand shock. So again, looking back to that, the 2020 Q2, you see where it was almost as bad as the worst recent Q2 in history, which was the 514 aircraft in 2019. And then you saw a pickup once the market started to open back up. Again, you may remember back in Q2, we couldn't deliver aircraft, at least from the general aviation standpoint. It was quite a high task to take aircraft and deliver an aircraft from Germany, flying 2 pilots or 3 pilots from the US and going through all of those hoops. What usually took a couple of weeks in the past took over 3 months, when you started to get into the COVID situation. So the market's freeing up in Q3 was a big deal. You started to see the momentum, and obviously Q3 was higher than 2018's Q3. And then as we moved to Q4, it even, blew it out of the water even further. 45% or so above the highest Q4 on record of 2018, and about 72% above the average that you see of Q4 performance on this chart. If you move to the next slide, I wanted to show you business jet utilization. And we took a baseline at 2016 showing non-commercial use, charter, and fractional. And so you could see the growth going up from, this is done by percentage. So you see the growth going up between 2017 and 18, and then continuing through 19. And then what you see is a 5% fall year over year on charter, and then 24 and 21% for fractional and non-commercial use respectively. So, I can't tell you that charter held so well because everybody was flying around in a leisure capacity, although, there was a pickup in leisure travel. There were also some inefficiencies due to repositioning. Instead of breaking away for a weekend where somebody would charter an aircraft and stay there for the weekend, their kids were doing school from virtual. So maybe they stayed in Montana for a month as opposed to going to Aspen for the weekend. A lot of those dynamics are going on as well. If you move to the next slide, I can show you the monthly perspective of charter and fractional. And what you see here is a historic look back to 2018. And you see that's a build from the previous years, as you saw in the previous charts. But as we come upon March and April, you start to see the effect of COVID. And, as Andrew had pointed out, we start to see a claw back coming after COVID, and then building into a normalization of the charter and fractional travel. One of the things that stood out for me is, December was a very strong finish. But the thing that stood out is with the January and February data, and February is not complete, but you can see that January held pretty strong as well in the charter and fractional world. Moving on to the next slide, what I wanted to do is kind of give you a perspective of one of the things that's interesting in having all this data and being able to take the value charts and normal financial data that we see on the market and put those all into one environment. Was a pretty nifty task. And we actually partnered with Bloomberg Intelligence. So our first run at this was to show what happened from the Great Recession. And you see the classic dip, and this is a percentage-based chart. So the first section here is actually the Great Recession. And you see how the values of heavy jets actually lags, as most of the time it does, with all of the other asset classes. So some of these asset classes we actually developed on our own from the aircraft manufacturers. We looked at some of the toys out in the industry, or the moto industry, with Harley Davidson and other instruments such as that we put into one index. And then transportation Obviously, logistics, you know, that's going to hold pretty strongly, and yachting. Now, the thing to notice is all the way up to 2000 and halfway through 2017 that yachting and heavy jet are very similar in that they don't move often and they lag the industry. And if you look at the next slide, we'll show you a close-up of COVID compared with heavy jet. So heavy jet is that last very thick black line in the middle of the screen. And again, when you look at that first section on this slide, that's the steep decline that you saw in all of our portfolio's or 401ks as COVID started to hit. And then you see that the S&P and the transport logistics held to the best. Obviously, you know, shipping on Amazon with the logistics and shipping held to pretty good. You see the deep dive everywhere else, and you see the lagged effect of heavy jet. You see where the rebound or the elongated V continues, you know, off, and you look at quarter two, or not quarter two, but you look at the second section of this chart, and you see that recovery as everything begins to rebound, that elongated V. And then in the third section, you see a little bit of that lagged heavy jet decline. And that's right now, the transactions have not caught up. We start to see that values went anywhere from a depressed 16 down to 23% holistically. And as Andrew had mentioned, you know, on the valuation of, or the values of these heavy jets, one thing that you'll want to notice is this is the existing market. And then we normalize that data across and we aggregate each serial number up to, you know, a make and model number, and that aggregates here to the heavy jet line that you see. And then you see a lot of movement coming in section 4, where that value starts to go up as the market frees up. It dips down a little bit and then continues upward towards the end of the year and rebounds, as you saw in the heavy jet curves that Andrew showed you. And then in section 5, the thing that I've noticed is, you know, if you look at yachting and some of those other asset classes, how much they picked up. And then the other thing that I noticed is that if you look at airlines and you look at leasing, aircraft manufacturers, those three have a definite correlation, and you can see where one goes, so does the other. So this is something that we've started out with the Bloomberg Intelligence team, and we're going to start to get predictive as to what residual values might undertake towards the future. But you know, for us, it was really an insightful task, and we definitely appreciated the help that we got. Moving on to the next slide, this might answer some of the questions that you looked at. We started this just a few weeks ago to look at the inventory, retail sales, new deliveries together, and then we'll also show that with the values. But this goes historically all the way back to 1985. And really the thing to notice here, or that stood out, is this is now a stacked area chart. It's not a stacked area chart. This is an area chart. I apologize. So what that means is that the gray area and the blue area start from ground zero. So that was not the case with the stacked area charts that I showed you earlier. However, the two first slides that I showed you are now represented by the dark blue new deliveries and retail sales. And the reason that we put those on top of each other was to show you the effect, or what I call the dynamics. Obviously, you know, new deliveries are what I would call the organic growth of the market. And you look at this and you're able to see where over time the new deliveries go all the way through, and you see the retail sales, and you look at a convergence and divergence of these three particular instruments that we're showing. And one of the things that stood out for me was, as you see retail sales peak and inventory start to be depleted, it actually calls on for a demand in new deliveries. And we've seen that probably 2 times over, 3 times if you look real close, but you see that cycle. The other thing to notice is look at the supply or the inventory back during the Great Recession. Reaching that peak is a pretty big tell of why values went down. Matter of fact, let's focus in on that. We'll move to the next slide, and I'll show you a close-up of 2007 all the way through 2020. And now what I've done is I've added heavy jet values. So up at the top of that chart, yes, it should probably say heavy jet values, but it didn't fit in, so I had to put a special note. Now, again, the interesting thing that we do here, and I know a number of you on the call probably have the valuation tool, and you can go down to the serial number level. You can add in the total time. You can do everything to make the valuation of that particular make and model more accurate. But the thing that I appreciate on this is that I can aggregate all those. So when you look at the green line, the value line, the axis to the right is in millions of dollars, and that is a 5-year-old jet through time. So in 2007, it was a 5-year-old jet, 2008, 9, 10, all the way through 2020, it represents a 5-year-old jet with an average total time of 350 hours per year. And the reason that's important is so we can isolate in and look at the effect or the market effect of value. So clearly, when we see the lack of transactions in 2009, but the oversupply in inventory, at the 47, 45 mark, you can see the values go down. And then you see that they diverge, and now they converge together, and they show kind of the classic supply and demand type of relationship. As that inventory goes down and starts to get consumed by retail sales in 2014, you see the values dip, or the values get back up, and then they start to dip again after the oil disruption. So, when you look at that through time, there's a constant transactions, and you also see the constant of inventory going to the right to 2020 where it picks up. So one of the things to look at here is that now, as we've had a blockbuster year in 2020, what starts to happen? The inventory is depleted, the values have come up quite a bit. Now that's a yearly average, so it doesn't show how values came back up towards the end of 2020. But what you're starting to see is those dynamics where we believe in the coming months, and I think you asked this question earlier, Nell, of what's to come. We see that once we have stabilization in some of the transactions and healthy GDP, and we start to see, the real spending come back, that the manufacturers will be called on, maybe not towards the end of this year, but certainly going on into the future. So looking at the next slide, I'd like to share with you what the data tells us and what we're hearing from some of our clients. So again, COVID-19 still continues to stress the GDP, and without true capital expenditure, we won't see that healthy stabilization of values and transactions, new deliveries in the industry. And then some of the 2021 orders were pulled into Q4 of 2020, and that causes a bit of a pause that we're seeing right now. And then obviously, I think as Andrea has shown you, inventory and new listings are down significantly, and which brings about what our clients are thinking. And the preferred inventory was picked over in Q4 of 2020, and that causes kind of a buyer's perspective of maybe we'll wait and see instead of negotiating on existing aircraft. Maybe we wait and see what might come onto the market. And then from a seller's perspective, they're saying, hey, maybe we should wait and see what's going to go on with the economy, and maybe those prices or values will come back up before we list into what might be a little bit of a discounted market.
Don, excellent. Thank you so very much. Our next speaker, Tony Koussis. Take it away, Tony.
Thank you, Nell. Thanks a lot to NAFA for the invitation to participate in this great panel. The subject I'm going to cover is the in-service aircraft listed for sale. And specifically, I'm going to cover 4 aspects of the in-service fleet that's listed for sale. The first will be market demand, which is on the screen right now, for inventory aircraft. Then we're going to go into inventory aircraft asset quality, followed by maintenance exposure, or the embedded aircraft maintenance that's out there in the inventory fleet, and then aircraft marketability. And my hope is that you'll see how all of these blend in with each other. Excuse me. These analytics provide a market view based on asset performance. not market sentiment, which is something that Rolly will be talking about, but the actual asset performance of the aircraft that have gone into inventory and perhaps sold. All of the aircraft analyses that you see and all of the aircraft analyzed are at the serial number level, and then those statistics are all rolled up to create the averages. And the data that we use to derive the calculations is sourced from JetNet, who's a partner of ours in the data area. Excuse me. So let's talk about market demand. Market demand reflects aircraft desirability from the way we measure it. And it utilizes a formula that's based on the days on market for inventory aircraft and the percentage of the active fleet listed for sale. The scale ranges from 0, which is low or no demand, up to 5, which is peak demand. If you look at Q4 in 2020, demand was up approximately 25% compared to Q4 of 2019. Large jets posted the highest demand. They're up about 44% versus Q4 of 2019. Mid-size jets were up about 18% versus Q4 of 2019. Light jets were up 29%. Although the small jets or light jets actually posted the lowest market demand figure. And turboprops were up about 7%. And turboprops are fairly, the numbers for turboprops, no matter where you look at the numbers, they're all fairly steady across the board. It's interesting, but demand, we expect demand to decrease during Q1. Sorry, you can note the demand decrease during Q1 of 2021 compared to 2019. We don't publish demand figures for we didn't publish demand figures for Q2 in 2020 due to the low trade volume. There just weren't enough numbers out there. And we expect overall Q1 demand to increase slightly. The January figures kind of tend to lead to that. Conclusion. Next slide. This slide deals with asset quality, and the asset quality rating is based on a standard formula that takes into account 2 maintenance statistics for all the assets. The first is the number of upcoming maintenance events, and it's based on each aircraft's maintenance schedule. And the second is the cost of upcoming maintenance events, which is based on information provided by operators and in some cases the OEMs. The information is computed again at the serial number level, and the group figures you see are then rolled up to create the averages. The scale, it runs from a -2.5%, which is the lowest possible score, which makes the aircraft unairworthy, to a high of 10, which is the highest possible score, which equates to a brand new aircraft. The quality rating scale definitions are on the right-hand side of the chart, and they cover 2020. The inventory asset quality rose 2.6% during calendar year 2020, and that's because lower quality assets were the ones selling, leaving higher quality inventory available. Large jets in December of 20 and January of 2021 were in the outstanding range. They were actually down 0.7% in January. The mid-sized jets were in the excellent range in December and January, but again, they were slightly down in January. As you can see, just a slight 0.1%. Light jets in December, in January 21, December 20 and January 21 were in a very good range, and they actually improved in January, by a slight 0.1%, and turboprops fell from December's excellent range down to very good in January of 21, with January falling about 0.1%. We expect overall Q1 asset quality to increase or improve as lower assets sell during the first quarter of this year, and January's figures are showing just that. Next slide. The slide covers what we call maintenance exposure. And the definition of maintenance exposure is an aircraft's embedded near-term maintenance expense. In other words, maintenance that it's used up. If to just give you an example, if an aircraft is a quarter of the way toward a double engine overhaul, and if a double engine overhaul is going to cost $1 million, the maintenance exposure for that aircraft, since it's a quarter of the way toward the overhaul, is $250,000. That's how we measure maintenance exposure. The aircraft group charts cover 2020 again, and maintenance exposure actually rose 7.5% during calendar year 2020. Overall, higher quality aircraft selling were the high aircraft were the ones selling. And in 2021, what we expect is a lower quality assets to sell during first quarter, which will decrease the maintenance exposure. As you can see in January, there were a few changes all the way around. The biggest change was in the light jets, which were down 3.9% in the maintenance exposure arena. Why is this figure important in the grand scheme of things? Next slide. The maintenance exposure allows us to compute what we call the exposure to ask price ratio, or ETP ratio. The ETP ratio measures aircraft marketability. It's equal, the ETP ratio is computed by dividing maintenance exposure by the aircraft's ask price. When the ETP ratio goes above 40%, aircraft days on market increase by 30% or more. The cause is really buyer and seller find it difficult to agree on a price for the aircraft, because when the buyer adjusts the offer price for the aircraft's maintenance condition, the seller finds the price unacceptable, and so they never reach a deal. The chart compares the days on market differential between aircraft with an ETP ratio below 40%, which are the green bars, to those with an ETP ratio above 40%. And if you look at it, the overall days on market were rising during Q2 to Q4 of 2020. Again, all these figures are computed at the individual, inventory aircraft serial number level and then rolled up. The projected days on market differential for assets with an ETP ratio greater than 40% is anticipated to be about 65% in Q1. If you look at Q4 of last year, the differential between the lower ETP and the higher ETP ratio aircraft was about 64%. It's a pretty substantial number, and the figures are very indicative of what happens as you sort of move across the years. The worst we've ever seen on the differential was in December of 2019, when the differential was 84%, and the least we've ever seen in the differential is 31%, which occurred in September of 2017. It's a very real figure, and it really does point to how long your aircraft is likely to sit on the market, if not, whether or not your aircraft is at all remarketable. And I think that's it.
Thank you, Tony. Okay, Rolly, you're up. You're it. You're going to bring us home.
Well, thank you, Nell. Appreciate it. Appreciate NAFA. Appreciate all of you for joining us today. Thank you to the prior speakers. I'll try to wrap us up here, bring us home. We have just a few slides. All of this information, of course, will be available to you afterwards. So thank you for being with us. When we think of the markets, business aviation has gone through, of course, a fairly significant shock, although the shock that we have felt as an industry, I would say, is less severe than many other sectors. So, let's remind ourselves of this. This is a good industry. Let's look really right now, though, at our owner-operator community. We have an ongoing survey of owners and operators. This is a worldwide data point I'll share with you here. We essentially asked them, where are we in this current business cycle? Now, clearly, we're coming from different places. Here in the US, where 60 or so % of our fleet, of the business aviation fleet, resides or is based. A lot of these data are going to be influenced by the mood, if you like, of the US market in particular. So think of a pendulum. A pendulum swings back and forth like our economy, like our industries, for example. Right now, and this is a really very fresh data. This comes from our Q4 survey. It was in the field just around the end of last year. We see that the pendulum has swung, and around half of the respondents to the survey that we have in the field are saying, you know what, we're through the worst of this business cycle. Now, of course, that's a big swing from where it was just a little while ago. So Tracy, if you want to switch us to the next slide, give you a little history here. Now, this is data going back, I think, till 2012 or so. And the height of this bar here reflects essentially the optimism of the market. So the higher the bar, the more optimistic the owner-operator community is feeling. This, as a reminder, is our voices of customer. We're trying to understand, obviously, the data, but behind the data, the mood of the owner-operator community. Look at where this chart has been. If you go back to Q2 of 2018, not that long ago, a couple of years back, this is the highest metric we've ever measured. It's plus 100 to minus 100 on this scale. Okay, so the higher the bar, the more optimistic. 55% net optimism back in middle of 18. We dropped to minus 43 just a couple of quarters ago, back in Q2 of 2020, at the lowest point we've ever measured. Where are we now? 27, positive 27 in Q4. And I just looked at the data points. We have a survey in the field right now. We're hovering around plus 31 to 35, depending on what day I look at. So the good news is the mood of the market is improving. Next slide, Tracy. Again, let's put a little bit more detail on this same type of data. Now we're looking at a line chart, and we break it out by geography. So we know where the aircraft and the owners and operators are based, and we just share this kind of level of detail with you. We monitor this every quarter, of course, but even more frequently than that on a real-time basis. So what's going on here? All of the regions seem to be improving, except a step back in Europe. And you can think of what's going on there. Obviously, second and third wave concerns regarding coronavirus and other factors at play. The split out of course, the UK from the continent. Next slide. One of the things that's intriguing to us is in our surveys, we can actually understand, if you like, the headset or the mood of the person who sits in the back of the aircraft. What we mean here is when they approach a business aircraft, they turn right, not left. Now, the interesting thing is when we ask people what is the feeling or what is the concern that people have as they step into the back of the aircraft, these are the things that are coming out in our surveys. We've run this a few quarters now in a row. And I would say in Q2 of 2020, in the middle of the pandemic's worst moments, the concerns were absolutely regarding things like the cleanliness of the aircraft and the training level and sensitivity of the crews. Now we're seeing a little bit of a different shift, and I think you can see it there on the chart. We're back to economics 101, which has always driven our industry. It's, it's the cost of the flight. That's a very interesting thing that's shifted. This is the most important concern that they have, the cost of the flight. Now, some of them may be chartering, some of them, it may be their own aircraft, but back to the reality of, this is a fairly expensive way of moving my team or my family around. I may be doing it more often now than I was, but, it's my primary concern. So as an industry, when we think of absorbing all this excess capacity that is in the system right now, the average utilization per aircraft dropped probably 30 points last year. We have a lot of absorption to do there. In fact, before we have to look to the OEMs to produce some new airplanes. So we'll talk around that in a minute. Okay, next slide, Tracy. Now here's really the OEM picture, if you like. This is the order backlogs as reported in the various investor reports and or filings and press conferences, press releases. We don't have the full picture yet even on 2020, but based on the first big three of the OEs that are reporting, the overall backlog dropped. It looks like around 8 percentage points on a value basis. So the value of airplane orders sitting in backlog. Now, the good news is we had a pretty good 2019, and you can see it here on this chart where the actual backlogs for the first time in maybe 10, 11 years actually increased, improved. So the backlogs give OEMs the confidence of, that they can set the production rates and there will be orders to be filled as those planes get ready and down the line. So most OEMs are sitting on around a year or so backlog. That's not the case in all cases. You have to really dissect this very carefully. But the good news is the backlogs are generally holding. Again, through the worst black swan event that I can think of in our industry in many, many, many years, we're actually holding fairly well. Next slide. Okay, there's something called book to bill. What is book to bill? It's an expression, but essentially a book to bill of one means that you're managing as an OEM your factory. So your factory, you're delivering an airplane and you're taking an order in to replace that delivery, meaning that your backlog, as we just described, is staying pretty stable. Now, the good news is in 2019, and you can see it here on this chart, the OEMs, the big ones anyway, moved to this point of performance where their book to bill was 1.0 or a little bit higher, meaning that backlogs in general were either staying stable or were actually improving a little bit as we saw. Now, the beginning of this, the reporting season that we're seeing for the full year of 2020, we don't have all the picture yet. But the first three OEMs have reported, and you can see on the chart, we have already a divergence of performance. We'll see where this goes. Next slide. This is really the wrap up. As if you weren't on the GAMA press conference call, the General Aviation Manufacturers Association reports quarterly, but the big report that they put out just maybe a week ago or so told us where we really ended up. Down around 20% in terms of overall units of delivery for business jets. If you look at this also from a business turboprop point of view, also down around 20%. So where are we going to end up this year? That's really the realm of forecasters. We're saying, we've been pretty accurate on this. We're saying that we'll be up around 8% on the business jet side. That may go up a little bit more, but right now we're going to call it 8%. Pretty good performance in Q4 from the factories. A lot of rush, if you like, to get to the year end. And we saw some OEs deliver almost half of their, and in fact, in one case, over half of their total annual output in Q4. So it was a busy time. Q1 is going to be a little quieter for a lot of reasons. Not only did we, as an industry, empty the shelf in a little bit in terms of that new product, new asset. It's just, we need to reset and get our teams going again in terms of selling. So Q1, it'll look pretty slow when the numbers come through, but for the full year, we think we'll end up around 8%. I just have one more point to make, and I think as an industry, we need to keep these in mind. We've been through two significant cycles in our industry. We're coming out of this one, but 12 years ago, and looking at where we were 12 years ago as we went into the global financial crisis to today, in the US at least, the US business jet fleet is 29% larger than it was going into the right at the end of 08, into the end of 19. Our US economy grew by 22% over that time on a real basis, meaning that our fleet grew faster than the economy. That's a good, it's not multiples faster, but it was a good performance. And the other thing to look at is if you look at 09 and 2009, that first full year of the global financial crisis impact on our industry, utilization levels in the US for business jet cycles to where they were in 2020, essentially at par. So we've gone through all of this period of time, 12 years, with no flight increase, no flight activity increase when you look at that. So do we have lift coming this year? Yes. Do we have capacity to absorb that lift? Yes. So all of that drives us to be a little bit more muted than some might be saying in terms of where this is going to go this year for the OEMs. But it's a good industry. We're growing and we're recovering and servicing our customers. And that's it. Thanks.
Raleigh, thank you very much. Thank you for bringing it all in and kind of a nice wrap up. Unfortunately, we're at the end of our time. Tracy, do you want to take it from here? We will respond to a couple of questions that we've received during this. We'll get to you. We'll get you back a response from the panelists that you identified.
Hi, sure. Thank you, Nell. Thank you so much. We appreciate your time today. We appreciate the participation of Andrew, Dawn, Tony, and Raleigh. This was a great presentation that was really rich with data and that hopefully will be helpful to everyone who attended. Thank you to all the attendees who stayed with us for most of the time. You asked some great questions. You were engaged, and I really appreciate it. Our next webinar will be in April, and we're going to do a lender roundtable where we will dive in a little bit further to what happened in the lending side of aircraft in 2020. And in May, we will have our annual meeting online. We were supposed to have our annual conference, but with the global pandemic, we postponed that one more year. So we will do our annual meeting online. That will be a members only event, but that will be in May. And then in June, we will have a regulatory update. So we will forward all of that information. Also, we had a lot of questions about whether we would post these slides online because there's a lot of data in there. So we will record this webinar, we will post it online, and we will post these slides with the webinar so that they'll be easy to find and easy to access. So thank you all very much for coming and attending, and we look forward to seeing you at our next webinar.